Hi, everybody, and welcome back to yet another cracking edition of The Matt Brown Show. This is the Private Placement Perspective series where I'm connecting you to the world of venture capital and at scale. So with us on the line is Scott Shane, the general partner of Comeback VC. Scott, welcome to the show.
Hello, thanks for having me.
Yes, we did it. Very good. We've been having audio problems here, guys, so bear with us. Hopefully we're all sorted now and the gremlins have gone. So Scott, thank you for being here. Comeback VC is doing some cool things. So why don't you give us the elevator pitch for our viewers and the audience around the world about Comeback Capital and what you guys are up to?
Yeah, so Comeback Capital is an early stage, pre-seed stage venture fund investing in software and software-enabled device companies located everywhere in the US and Canada except Silicon Valley, San Francisco, New York City, and Boston.
And Scott, was the reason for that personal or was the reason for that just strategic? Or a bit of both?
Well, the reason is twofold. The first reason is that there's plenty of venture capital in those places, and so we don't have a competitive advantage. The second reason is that our origin is that a bunch of big name coastal VCs came through, traveling through the Midwest in 2017, 2018. We're looking for a mechanism to invest in those parts of the country, and they were part of the origin of Comeback Capital. So a big chunk of our LP base are partners at big funds from San Francisco and New York looking for ways to invest in the rest of the country.
Very interesting. Very interesting. That's an interesting strategic point of difference, I would say. But I'd love for us to go back just a little bit further. Scott, how did you get your start in venture capital? How did that actually all come about?
Well, so I got started in venture capital because I started as an angel. And I started as an angel investor because my long-term occupation has been as an academic researcher and teacher in entrepreneurship. So way back when I was teaching at the Sloan School at MIT, I thought that I would seem like a cooler professor if I invested in some startups. And so I made my first investment in some MIT students that were starting a company. I got lucky the first time around. It was successful. So I continued angel investing, and that's what eventually led to creating a venture fund.
That's so interesting. A professor who wanted to be cool. It's funny because I asked that question and it's so surprising. I was just saying this on the previous show, how varied it is. It's so diverse, how venture capitalists get into the space.
Well, I mean, to think about it, right? It's hard to be very practical when you're just doing the academic stuff, and I wanted to make the investments. I will tell you that over the years, I've learned that there's a whole lot of value in the doing that helps you understand how it really works. And at the same time, there's a lot of value in having a research edge in looking at companies and patterns in investing.
Mm-hmm. And we're going to come back to that in a moment. But Scott, let's talk a little bit more around what are you actually doing on the ground there. So walk us through, what's the typical check size look like? What stage of early stage? Because there's different types of early stage. Are they pre-revenue, revenue? Are there industry focuses that you have a preference for? Walk us through what that looks like.
Yeah, so we have a pretty tight profile on what we're looking for. We don't want to invest in pre-revenue companies. What we want are companies that first have a handful of customers, right? So we're talking companies that have maybe $2,000 a month revenue from 4 pilot customers, something of that order of magnitude. The companies are less than 2 years old typically. We want to get them at the beginning, but we don't want people who are struggling to sell something that the market wants. We write $250,000 checks into companies, but our LPs are very active investors in sidecar with us. So what we say is we do $750,000 to $1 million rounds in early companies.
Right, got it. And when it comes to your particular niche, what role does the location for where you are play in your ability to source deal flow?
So we are located basically we have partners in a bunch of cities in the middle of the US. We've got a bunch of people who are LPs that are located in a variety of places. We think it's a big advantage because we are both fast moving investors. We're 14 days from first meeting to wired money, and we always meet that schedule. And we're investing in places where there aren't a lot of venture capitalists. So it's a big advantage to be able to go into, say, Omaha and say, hey, we're going to do those deals. And isn't a lot of competition.
And would you say that Omaha, for instance, Salt Lake and various other, suburbs or ecosystems, startup ecosystems in, the central part of America, because obviously you have your tier ones, New York, Texas, Silicon Valley, and all these sorts of things, they're all very established. But would you say that that these startups that have revenue, they have customers, but they're looking for capital, that they have been typically underserved historically?
So there's a couple parts to this. The first part of it is that we see there being the San Francisco, New York, Boston, Silicon Valley as one kind of ecosystem. And then you get places like Chicago and Austin, Texas at the next level. We actually find that those aren't even as good for us, although we'll do investments in those places. What we really love is what you might call a tier 3, even though it sounds pejorative, because there's almost no one playing in Omaha, in Kansas City, in Boise, right? In those places. And when you play in that, you have a lot of the ability to pick and choose because the other people aren't there.
Mm-hmm. And so what makes you guys, I love the idea of speed. I mean, if you can get a check cut in 14 days, I'm all ears, and I'm sure a lot of others are too. What over and above that, Scott, makes you guys special?
So we are willing to price risk. And I think most venture capitalists don't price risk. So what we'll do is say, okay, look, your company is 10 months old. You have 3 pilots, okay? You are bringing in $1,500 of revenue. You need to hit a milestone of getting to like 5 or 6 actual contracts with customers. You need $750,000. We will set a cap on a safe and we will get you the round done. Most investors don't do that. What most investors will do is say, okay, sounds interesting. Come back to us when such and such has been the milestone. But the problem is, if you don't have any money to get to the milestone, you never get to the milestone.
Yeah, it's a chicken and egg scenario. By the way, if anybody ever asks you that, Scott, you must just tell them it was the chicken, because you can't actually have an egg before a chicken. You know what I mean? Like, it's a ridiculous question. I had a potential client. They were like, we need to raise money before we can use your services, and I'm like, no, you don't. No, you don't. And they were like, it's a chicken and egg scenario. I'm like, no. There's always the chicken. You actually need to just do it. Anyway, side notes. I want to quickly talk to you about the macroeconomy because it's a standing question I have. If you guys have been following along, and it matters. It does matter from what other VCs have been saying. So Scott, what's your view on the macroeconomics? Like, what role does that play in your ability to issue, investments to startups? As an example, are you more selective? Do you not care? Is it the fact that you've got LPs that are looking for a return? You have a fiduciary responsibility to give them a return. So you're just going to cut those checks as long as they're revenue generating. And, you've come up with an innovative way to price a safe. That's amazing, right? But so over and above that, you're doing all these cool things, but with your VC hat on, the macroeconomics, everyone, cost of capital, things like that. How much does that factor into your decision making?
Okay, so you should understand that as angels, we've been investing since 1998, right? So we've seen several bubbles and we've seen several downturns. And as an investor, I prefer the downturns. The reason why, what was difficult for us were years like 2021, when everybody was just chasing deals. Their cost of capital was zero. People were being irrational. What's happened now is a bunch of other people are not investing, and we're looking for good companies, and the good companies are out there. So we love this environment. We think it's a better environment in which to invest. Now, to be honest, what we focus heavily on are the new young companies, right? So for us, those companies aren't stuck usually, right? They didn't go raise money in 2021, now run out of money, raised too high, and are looking for deals from us primarily. They got started in 2021 or 2022 working on a project and now are first raising money. Those are good opportunities for us. So yeah, the macroeconomic environment is terrible and we love it.
Yeah, I'm so glad you said that, because I actually agree. It's like, when is a good time to found a startup? When is the good time? There's never a good time.
When a good time,
like I would say it's the best time is actually in a depressed market, because if you can cut your straps in the worst of it all, when things turn around, then you know that you've got a great business.
We look at this and say founders start companies when they have a good idea that the market wants and something that's developed. Now, that's really not correlated with the macroeconomy. So the investors are the ones whose behavior is a little bit unusual. They all want to invest when everybody else is investing and chase the deals. Then suddenly when the economy isn't good, most investors don't want to invest, yet the same number of good companies are out there because entrepreneurs are coming up with ideas when they come up with ideas.
Yeah, timing's a big one. Have you watched that Bill Gross TED Talk?
Yeah, I have.
Have you watched that where he talks about, for everyone else, it was basically do you want to tell everyone?
The hard part about this is that if you do what everybody else does, right, at any time, right, you're going to chase the same thing that they're going to chase, and you can't be a winner, right? So if you're going to invest when other people aren't, your chances of being successful have to be higher because you're doing something different than the other people. I don't understand it. I've never understood the investor mentality. But then again, we're not a big fund, right? So we're not kind of going there saying, well, there's a bunch of people who are institutional investors throwing money at us, and when the cost of capital was zero, we just had too much money, and so we chased deals. We are a very different financial structure, and I think this is important. The partners at Comeback Capital are 40% of the money in the fund, as compared to a typical VC fund is 2% GP commit.
That's really interesting, right? And on the LP side of things, Scott, how do they respond to the venture space when things are the way they are? If they're taking hits in the public markets, and they for argument's sake, they might put their capital into more safer investments, you know what I mean? And then like bonds or whatever. But then you've got this. Is it an attraction of venture stage investing? Like what have you learned talking to LPs about how they approach or how they view venture stage investing when things aren't, bright and sunny outside?
Well, there are a couple points that I would make, and I should preface this with saying we're atypical, right? Because our LPs are generally sophisticated, high net worth individuals, family offices, and individuals in the middle of the country, or they are partners or venture funds that are located in San Francisco or Silicon Valley, and they're looking to invest in the middle of the country. And I say that because the more sophisticated the investor LP base, the more they think about the long horizon of venture investing. And we're investing at the early stage. We're not like people who write the checks, a year before the IPO. We're investing in companies that probably won't have an outcome for 7, 8, 9 years. You tell me what the macroeconomy is going to be in 7, 8, or 9 years, and I'm going to tell you I'm just going to give you all my money because you are a great forecaster, right? Nobody knows, right? So investing in the companies now shouldn't be related to the current economic conditions because you're not getting the exit now anyway.
Yeah, I agree with you entirely. So let's talk about your portfolio. So I know you touched on a few of the check sizes, and there must be revenue generating and things like that. Over and above that, what are the sort of factors that get you to say yes to a deal? Because you don't have to. I mean, if you get pitched all the time, you don't have to. You can also say no. So what gets you to say yes?
So, okay, there are a couple of things. The first thing that we focus really heavily on is what's the problem that they're solving and what's the order of magnitude of that. So if you tell me a customer is going to get a return on investment of 10 times their money by using your product. Okay. So, they pay you $1,000 and they get $10,000 of benefit. I'm going to be very interested. You'd be surprised how few founders tell us that they don't focus on the value proposition enough, and they don't quantify the value proposition. When there are good numbers, we get really interested. That's the number one thing.
Interesting. And is there anything else that you look for? I mean, there's this idea, isn't there, about you back the jockey, not the horse. Is it a bit of both for you?
So we are less focused on the jockey than the horse. We're much more balanced than most people. We want to hear the value proposition, and we want to see that the people are good jockeys. Now, the reason I say that way is that we are almost always investing very early in first-time founders. So it's very hard to actually know, is that a good jockey, right? Because they haven't done any of the things that would tell you that they know how to do that, right? If they had already, built an organization with 1,000 employees, it's easy. But then they don't come to us because they went and got money from the people who backed them the last time. So we do look at that. That's important. We are big evaluators of the time to accomplish something. So we look at a company and say, okay, how old's the company? The company is 10 months old. Most companies don't actually have a product in 10 months. Most of them have no revenue. So you tell me your company is 10 months old. You have 6 paying customers, each paying you $1,000 a month. I am super excited, right? It's like looking at children. No one expects the 1-year-old to do calculus. But if you find a 1-year-old who can do addition, you think that's a child prodigy.
Mm-hmm. Yeah. Yeah, it's interesting. I was a side story. I was putting my son Franklin to bed. He's 8. And I was playing with him, first time. I'm trying to do an analogy of a first-time founder being a kid. They don't really have, 25 years of building companies of experience. So they're coming in completely green. And so this perspective is oftentimes worlds apart from reality. And that results in projections that don't make sense. They're not really going to be a unicorn, but they believe that. You know what I mean? And so anyway, context. So I was putting him to bed, and I was showing him ChatGPT, and I was like, check this out. It can show you the distance of Pluto from the surface of the Earth, depending on the rotational system of the planets and the da-da-da. And he said, can I have a go? And I'm like, yeah, sure, go ahead. And he goes, cool. So I'm put on the speaker dictation, and he says, tell me a story about a boy who can only say goo goo nana boo boo. You know what I mean? And it was I was expecting him to be impressed by the cool stuff, the real world reality stuff. But as a first-time individual human, I know he's young, but to be exposed to artificial intelligence, the reality of it and what it can be, sometimes that perspective is so huge, it's so far apart that we often forget just how much work is required to get an individual first-time founder to understand the realities of scaling a company, building a team, distributed team, building a great product, MVP, blah, blah, all that stuff, raising money, multiple rounds, and for a first-time founder, there's a reason why, VCs make so many bets, don't they, Scott? Is to hedge and say, hey, if you don't make it, startup C, I have these other, 20 one options?
Yeah, so the diversification is certainly important. There's another piece of this that we focus a lot on, which is what is the milestone you're trying to achieve that is reasonable with the money that you're going to get, right? So if you're going to raise $750,000 or $1 million, and what are you doing with that? And in 9 or 10 months, what is the milestone that you've achieved? And we focus very heavily on that, because people who tell us, okay, they have a vision and they're going to have, $100 billion company in like 10 years, it usually is very amorphous, right? If you tell me, well, I'm going to get from 1 pilot to 7 pilots with $400,000 in 6 months, and here's how I'm going to do it, we're much more interested because it's a milestone that's achievable, and then we can understand how the value of the company increases.
Would you invest in a startup you had contracts, for example, with clients who are prepared to pay $4 million over the next 2 years? If you had that kind of collateral, would that make it worthwhile for you to consider?
Yeah, so we look at revenue as having various stages, right? So like the revenues actually come in, the money's been billed, right? That they signed an agreement and a invoice was sent, right? And then there's they signed a contract to pay money. Below that level of a contract, we think it's not real yet, right? It's not there. But a signed contract, contracted revenue, especially depending on the business, could be very valuable. How often do people break the contracts? In some industries, it's very rare that you would break the $1 million contract that you signed. People, paying, let's say, employee benefits, it's kind of hard not to follow through on the health insurance you promised your employees. So if you paid for that, if you contracted for that, but you haven't paid yet, it's probably coming in.
Yeah, absolutely. Okay, cool. That's good to know. We're going to take a quick break, Scott, and then we'll be right back. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. So, Scott, I was looking at your portfolio on your website, and I was showing it for everyone. Excuse me, friends, going off. One second. It's the wife. Sorry, love. My question is, in all these investments that you've made, what would you say has been your greatest success and failure, and what made the difference?
Well, keep in mind that our first fund started deploying money in 2018, right? And we're investing early. So most of our successful companies have gone to raise a lot of money later, right? And so we've got companies, for example, Path Robotics, where we were in the very first round of the company. I think they've probably raised a couple $100 million at, very high valuations since. I would consider them to be a success. Or a company like FloatMe, which is also, we invested very early in a very early safe round, and they've raised several times. So our biggest successes are actually not the ones that have distributed money at this point, because the early exits after 3 or 4 years are the 2 and 3 times your money back, right? Which is, it's better to have money back and have a multiple than to lose money, but they're not the big winners, and they're ultimately big. In terms of what's most the difference between the ones that have done well, and we've had probably 75% of the companies we've invested in have gotten marked up. So the vast majority of the successful companies that we've had have really found their niche, solved a problem for customers, and added and grew on the revenue side. That's the big differentiator. The ones that were unsuccessful, they tried something, they thought it would work. It didn't work. They tried a second time. It didn't work. Basically, if you tried 2 pivots and it doesn't work, you're probably gone. I mean, you may not be over, but chances are very low.
So what's your one piece of advice, Scott, to a founder who wants to, him or her, that wants to raise money from a venture capital firm such as yours?
Find a customer or 2 and show that that customer is paying you money for the solution to their problem that you have. That, I think, is the single most compelling thing that you can do with an investor. And when you reach out cold to an investor, if you're doing that, tell them that. Don't write a several page long email that doesn't tell you that key information and that's all about the future. I would say what problem you solved and how valuable it is to the customers. I think that's really attracts attention.
Cool. I love that advice. Scott, when you do an investment, do you have a particular capital structure that you use, or is like safe note, convertible note? Do you not? Does it depending on revenue size or pre-revenue? Walk us through how you approach that.
When the company is really early, like we invest, it's almost always on a safe note, almost always a post-money safe these days. We're fine with convertible notes. The problem with a convertible note is it's not a standard document. So then I have to go spend a lot of time reading the note to see what crazy things people put in them, or pay a lawyer to read it, which is like find the crazy things in it. And I have to pay money to the lawyer, right? And so we prefer not to go with convertible notes because the safes are standard documents. We will do priced rounds. Generally, it's not worth the expense for the company to do a priced round if they're raising $500,000 or $750,000.
Yeah, got you. And Scott, when you think about exits, so what factors go into your decision making when it comes to deciding to sell an investment, or do you not sell it? You just hold it for as long as humanly possible, let the founders decide. There's no secondary market sale for you. How do you approach this exit opportunity?
So I think it's important to think about who we are as investors. So we're investing at the pre-seed stage, which means that the company's probably going to raise a seed round from investors. Then they're going to raise a Series A and a Series B, and then maybe there's going to be an exit somewhere further around. There might be a secondary, there might be an acquisition, maybe way down the road in some of the companies, there's an IPO. Because we're the really early investors, we matter in getting people from pre-seed to seed stage. It's kind of like thinking about kids in school. We're like the kindergarten teacher. So we matter a lot in making sure you know what to do to get into first grade. When you're getting into high school, we barely matter. And certainly when you're getting into college, we don't matter at all. And what that means is in the decision making, it's not our decision about the exits. We take them. And so what we're focused on is that we've got a good enough position that when these outcomes are revealed 8 years later, they're good for us.
And Scott, in terms of your sleep, what keeps you up at night when it comes to your portfolio or the world of venture capital? What's on your mind?
I mean, the truth is the hardest thing for us that we worry about all the time is finding new good companies, right? I don't worry about the companies that have problems when they have them, because human beings are pretty resilient and they figure it out, and we're diversified, and some of them won't ever figure it out, and that's embedded in the portfolio. The hard part is, okay, in 2020, I found a really good company. Well, that doesn't do me any good in 2023. How do I find the good companies in 2023? It's constantly, where do I go? Where do I find these people? How do I know about people who just started a company? There are 2 of them. They're sitting in somebody's garage in Kansas City. How do I find them? That's what keeps me up.
Mm-hmm. So what's the source of your deal flow currently then? Is it someone, I suppose they would find you primarily?
No, so we do a lot of outreach. We found that we do a lot of events where we organize and bring people together in a lot of different cities. We find that that support of the community helps to bring people out of the woodwork, and then we find companies. We also find uh, a lot of competitions that are done in cities to be very good. We found some great companies out of student competitions very early, where you look at them and you go, well, that's a real solution to an actual problem. That's a cool company. So we do that. We used to find that accelerators were a very good source for us. I think that there too many companies got created during the bubble and went into accelerators, and so I think that system is working its way through, and so we're starting to see good ones from deal flow again. Our best source is founders we've backed that know other founders. That's the best. The second best is probably VCs that we've co-invested with. To be honest, the worst is VCs that send us deals that we have never done their deal before. Because they're looking for something different than us, and we think they're just trying to sell us the lunch they didn't want to eat.
Yeah, exactly. Here's a hot potato.
Exactly.
That's funny. Tell me, Scott, you've been in the game a long time. When you cast your mind forward 10 years, how do you see the role of venture capital evolving? And what would you say is the likely impact on founders in the future?
So one of the things I think there's a long-term trend, and I think it was driven by COVID changing attitudes, is that the idea that you can invest in people anywhere has been a transformative process. And I think that's an increasing trend. I also think that we're seeing a lot more growth in diversity of the managers that run the funds, right? We're getting more underrepresented minorities, women running the funds, which I think is also really a valuable thing, because it's very hard to judge deals that you don't understand, right? We don't do a lot of consumer deals, but it's particularly hard for us to do consumer deals that might, say, focus on young women as consumers. If I'm not a young woman consumer, I don't really know what a young woman consumer wants.
That's true, Ham. What about things like artificial intelligence? Because one of the things that has come up a few times now, speaking to a few general partners, is that it was said really well to me recently. He said, my greatest worry is that my portfolio becomes a reflection of my biases.
I mean, we tend to not bet on technological trends because we've seen a lot of them come and go, and generally we focus heavily on the problem that's getting solved. So, I don't know that I would try to make any predictions on any technology, because I don't know what the technologies will be in 10 years any more than 10 years ago I knew what the technologies would be today. In terms of how people will make decisions, I do think that there's going to be a big transformation in venture investing, that it will become more professionalized, if that's the right word, more quantitative, because there will be an ability to use more data. It's one of the last investing cottage industries around.
Yeah, absolutely. So I'm going to have a quick bit of fun with you, Scott, and then we'll wrap up. So I'm going to give you the keys to the Matt Brown Show time machine. And you get to go back to yourself on day one when you were an angel and you were just starting this whole journey of venture capital investing, angel investing, and so forth. What advice would you give yourself on day one about investing?
Don't invest in what I just saw, because I don't actually know enough to judge. The biggest mistake that I made, and I think most early investors do, is they invest in the first things they see without knowing what good is.
So why is that?
It's pretty exciting to invest in early stage companies. I mean, it's one of those things. It's pretty cool. People are solving problems that hadn't been solved before. They're proposing those ideas. What you don't realize is how hard it is to find people who can do that. Problems that customers will really buy. Will pay money for, that kind of stuff. And so everything looks good at the beginning until you start to see enough deals to go, oh, that one is really much better.
Mm-hmm. Do you worry about your portfolio and their ability to get a return for your fund? Is that ever a concern, or do you kind of like, well, I've been in this game long enough, and I know, to your point, I know what's a good deal and what's an average deal. It's okay, you could do it. If I wasn't experienced, I'd probably do it, but I'm experienced now and I've looked at so many that I'm actually only interested in this top 20%. And you know what I mean, like, so when you cut all these checks, do you worry about the portfolio, like, hey, are these guys actually doing what they said they're going to do? Because when I speak to GPs, they literally say, like, no one makes their numbers, they don't make the projections.
So a couple things on this. One, we don't believe anybody's going to do anything that they say they're going to do. And that means that they tell us they're going to give us an update, and probably they won't. And we're happy at the few who do, right? People tell us they're going to hit their projections. We figure most of them won't. And we're happy when a couple of them actually do, right? We don't worry in the details. What we're trying to do is build a portfolio that says, if I have 100 of these companies that look like this at this price, will my overall portfolio do well? And the answer is yes. And then I don't lose sleep over that this one doesn't do as well as it should, or that one. And by the way, over 20-something plus years of doing this, I am mostly wrong at my self-assessment of which ones are going to be my big winners. I can tell you my biggest winners, I didn't think were going to be the best.
And curious, what do you put that down to? The inability to really know? Is it just because there's so many variables in the world that
because the future is uncertain with like a zillion variables of uncertainty? It's just unknowable.
Yeah, gotcha. Alrighty. Well, look, Scott, thank you so much for being on the show. It's been a real privilege having you here. It's great to see what you guys are doing. You're cutting checks. You're really helping early stage guys. I know how frustrating, having raised money myself, bootstrapped also myself, how important you guys are. So, yeah, thank you for doing what you do.
Well, thanks for having me on the show.
Anytime. Thanks, everyone.